And welcome to the fourth video in the series of inventory accounting illustrations. This one will be periodic system FIFO. To review, the first three were applications of the perpetual system. The first was perpetual FIFO, then perpetual LIFO, then perpetual average cost. Now this one will be periodic FIFO. We will then do periodic LIFO and then periodic average cost. And remember, under the periodic system, the hallmark is that we will not account for the inventory transfer when we make a sale. We will simply count the inventory and apply its value at the end of each accounting period as an adjusting journal entry. So the disadvantage of the periodic system is that if you look in the ledger at any point in time, you're not going to know your inventory value. And if you look in the ledger, you also won't know the cost of goods sold to date. But the advantage of the periodic system is that it's less expensive from an accounting viewpoint. Let's illustrate the mechanics now. Again, this will be periodic FIFO. Remember the facts. We started with 400 basketballs in inventory at the beginning of January, and we purchased those late last year for 25. On the 8th of January, we purchased 200 more, which gave us 600 total. Then we sold 250, we were down to 350. We purchased 400 more. That brought us back up to 700. And then we sold 200. Brought us up to 750, by the way. So during the month, we had 1,000 available for sale. Those 400, these 200 we purchased on January 8th, and these 400 we purchased on January 19th. We sold 450 of them, 250 on the 10th and 200 on the 25th, and we had 550 in ending inventory. That's what became of the 1,000 we had available for sale during January. All right, at this point, let's adhere to our usual habit. Please pause the video, work the case. It shouldn't take you very long. And then come view the video and see that indeed you had it perfect. I'll see you in a minute. Right. Welcome back once again. There's the summary of our inventory transactions and our purchases and our sales during the month. And there's the journal entry we made on January 8th when we made this purchase. Excuse me. And that was, of course, 200 balls at 28. On January 10th, we had a sale, 250 at 500 at 50 per ball. Total of $12,500. Now, the hallmark of the periodic system is we don't have the entry to debit cost of goods sold and credit the inventory for the inventory transferred out. We just make that entry as an adjusting journal entry for all the sales that occurred during January. On January 19th, we did have another purchase. And I should emphasize that we're using a purchases account. which is really, I put plus expense or plus asset depending on how you view it. But basically, this is an asset account right now that is viewed in conjunction with the inventory, the beginning inventory balance. The cost of goods available for sale during the period will be the inventory plus the purchases. And so right now, that's what our accounts look like related to inventory. We have the inventory beginning balance. There's the posting of the January 8th purchase to the purchases account. Let's call this purchases. So this is what we had on January 8th. And then we add these to the purchases, the 5,600 and the 12,000, when we posted the two purchases we've made. And so our inventory is comprised of the 10,000 of beginning inventory and the 17,600 of purchases. So once again, the cost of goods available for sale is 27,600, just like it was. That 10,000, this 5,600, and this 12,000, and then we will see at the end how that splits between the cost of the balls that were sold and the cost in ending inventory under the three cost flow assumptions. There is the January 25 sale. And that brings us to the important learning here, the new learning. And that is the adjusting journal entry for inventory. All right, I'm going to put it out here, and then I'm going to talk about what order I did this. The first thing you do is you zero the inventory, the beginning inventory account out and the purchases account. We then are going to divide that 27,600 cost of goods available for sale between cost of goods sold and ending inventory. And you may do it in either order. You can compute the ending inventory as the 400 at 30 and the 150 at 28, because the 450 we sold are assumed to be those 400 and 50 of those. Or you can do the ending inventory, which at FIFO is 550, which is 400 from the purchase, all of the purchased at 30, and 150 of the 200 purchased at 28, or 16,200. So cost of goods sold is 11,400, and ending inventory is 16,200. And that's the periodic system. Again, the hallmark is that we did all of the inventory and the cost of goods sold at one point. We just added all the purchases into this account. We had the beginning inventory in this account. We zeroed those out and reestablished the balances based on FIFO, first in, first out. And so there's what after we posted the adjusting entry, There's the 10,000 zeroed out credit and the 16,200 debit. And there's the cost of goods sold from the adjusting journal entry, 11,400, which again is just the posting of these two debits and the posting of these two credits. And so there is your financial statements, the ending inventory of 16,200 and the cost of goods sold of 11,400. Needless to say, the sales revenue are the same. That didn't depend on the cost flow assumption. Okay, so that is periodic FIFO. In the next video, we will do periodic system LIFO cost flow assumption. Again, thanks for your hard work.